In this video, we're going to go over how lines of credit are calculated. Not only how they're calculated, what you need to qualify to get a line of credit, how the payments are calculated, and basically we're going to go through every single detail of what's entailed in getting a business line of credit. So make sure you stay to the end. I'm Jonathan Fodera. I have been in business financing for the past 14 years, and I've helped thousands, tens of thousands of clients get lines of credit and other financing programs. One of the first things you have to understand is what underwriters are looking at when they're looking at approving you for a line of credit. So first, they're going to look at your time in business. The longer you've been in business, the less risky you are, right? Next, they're going to look at your cash flow. So cash flow involves several different items, right? So cash flow is the amount of revenue you do each month, how many deposits you do, how much money you keep in the bank, so your average daily balances, and they want to see if you have any negative days. Negative days are going to set you back, and if you have a lot of negative days in your business bank account, it shows that the business is stressed out from an underwriter's perspective. So it's very important to maintain good cash flow. A lot of people always ask, what is that ideal balance on how much should be in there? Well, if you keep 10% of your revenue in there, so if you're doing $100,000 a month in revenue, and you keep $10,000 at all times, you're in a good position. Same thing, if you're doing $40,000, you keep $4,000. If that is a strong or decent cash position when an underwriter is looking over your application. So the next is going to be credit. It's not just personal credit, but personal credit comes into play. Typically, you have to have personal credit above 650. The higher you go, the better it's going to be, the lower the rate you're going to get. Next, they're going to look at your business credit. They want to make sure that you have established business credit. That shows that you can handle additional payments. So I want to give you a story about a client we recently had. His name was Ed. He owns a bathroom remodeling company, and he came to us after being turned down by the bank for a line of credit. And what we were able to do is we were able to look at everything that he had going on. He had 680 credit. He's been in business 3 years, and the banks just weren't comfortable. We were able to get him a line of credit for $100,000 over 12 months at 7% simple interest, right? It had monthly payments. And what this did was it allowed him to draw on that line of credit to build and scale his business, meaning he was able to use it for short-term needs. One of the things he said to me was, I can't believe a bank turned me down and you guys were able to get me approved. I really appreciate that. And we were able to do it in 2 business days. So from the time he submitted his application to the time he had everything set up and he drew, it was only 2 days. And I'll tell you, it wasn't a lot of documentation. So one of the benefits of a line of credit is that you don't need the same amount of documentation. It was just a 1-page application, his last 6 months of bank statements, a driver's license, a voided check, and his most recent business tax return. And that was enough to get him pre-approved and then set up his line of credit. And I can tell you, just by looking at his business, he really needs it because he has a lot of short-term costs. So he has to buy supplies and inventory to work on his current jobs, his current remodels. Once he's done with those remodels, he gets paid, he can pay off that line of credit. That makes a ton of financial sense for him, and it still keeps his margins very high. So his net profit should be great at the end of the year as well. Now, let's go into what underwriters are going to look at and how they calculate how much of a line of credit you're going to qualify for. So sticking with the revenue perspective, right? If everything else matches up, meaning the time in business is good, credit is good, cash flow is good, they're typically going to approve you for 25% to 75% of your average monthly revenue. So they'll take the revenue for the last 6 months, and then they're going to approve anywhere between 25% of that and 75% of that. And how do you wind up getting a larger line of credit? Well, it's simple. With a larger line of credit, okay, if you have better credit, better time in business, and you're keeping higher average daily balances and you're showing good cash flow, good steady cash flow, you're going to be on the higher end of that range. The one thing that could impact it is if you have other debt. So typically, if you have other debt that's coming out of the bank, they factor that in to make sure that you can afford the payments. So in this situation with Ed, he was only in business 3 years and he had an SBA loan in there and one other type of financing. I think he had a working capital advance. I'd have to look at it again. Essentially what happens is in that situation, they said that they were only going to give him 50% of the revenue. So he was doing $200,000 a month. He got approved for $100,000, and all in all, that made sense. Now, the next thing Ed asked me is, well, how do I increase this line of credit? Well, like anything else, one, the bank wants to see that you're using the line of credit. So if you're using the line of credit and you have no issues with repayment, meaning there's no bounce payments, all the payments are made on time, your credit stays strong, the revenue in the business stays strong, if you can show that you're utilizing that line of credit, at least 50% or more of that line of credit, after 6 months you can get a review, and what we do is we ask them for an increase. So every 6 months you can go in and ask for an increase, but there are certain situations it doesn't really make sense. If you're approved for a $100,000 line of credit and you're only using $5,000 or $10,000 here or there, and you're never going above 50% of that line of credit, well, in that situation, you're showing that, hey, you're good sticking between 10, 20, or 30,000 per draw. So there's no real reason for the bank to increase it. Now, if you're using the entire line of credit, well, then there's a reason. You're showing that you need more credit than what's being provided. Now, on the flip side to that, there is a danger. You don't want to max out a line of credit and keep it maxed out, meaning you want to show that you'll pay it down and have that availability there. So there is a sweet spot. If you're using between 50 and 70% of the line of credit and paying it down, well, you're being a responsible borrower, and that will help you get approved and increased in the future. When we did everything for Ed, we went through that with him. He knows, and so in 6 months, he said, thank God someone actually took the time to teach me this, because in 6 months, now I feel comfortable, now I have a plan of action, and I know that I can go and count on you to get me that increase as long as everything is made, and worked on properly. So that is really the key in how they calculate it, and it's also a key in how you get an increase in the future. The next thing I want to go over with you is how the payments are actually calculated. So if you look at Ed's example, he had a $100,000 line of credit available to him at 7% over 12 months. His first draw was $50,000. That's not what we determined, that's not what the bank determined. He had all $100,000 available to him. He chose to draw $50,000 to start. $50,000 over the 12 months, the payment was roughly around $4,300. That's principal and interest. At any point, if he wants to pay that whole thing off, all the remaining interest is waived. And if he takes any subsequent draws, a subsequent draw is if he were to come in and take another $20,000, the payment would be recalculated based on his existing balance and what he drew. That is how they calculate it. They calculate the payment based on the term plus the interest over how much you're drawing. If he were to draw $25,000, his payment would roughly be half. It would be about $2,100 or $2,200 a month. And if he drew the full thing, his payment would have been double. It would have been about $8,600 a month in payments to pay down that line of credit. So the calculation on how he pays is based on the draw itself and the terms of the line of credit. And the really nice thing, the really convenient thing, is that when you're doing that, there's always an online checkout portal. So you know exactly how much you're drawing, what the origination fee is. The origination fee is usually between 2 and 3%. And he knew exactly how much interest he was going to pay if it went full term. And he knew exactly what the payment is. So anytime he logs in to draw, it'll recalculate everything automatically. So there's no questions. And this is really helpful because business owners need to know what the payments are going to be. They need to be able to plan as a business owner what their cash flows are going to look like for the next few months. That's a real big key to growth. So Ed was very appreciative. He told me, he goes, thank you so much. This makes so much sense. I wish my bank could have done this for me. So let's recap, what we've gone over. We've gone over how a line of credit is calculated, what you need to do to get approved for a line of credit, and we also know how they calculate payments and how they determine how much you're going to qualify for. So what are some things that you can do today to get ready? Well, first off, you could have all your statements ready, meaning you could have all your bank accounts always saved to your desktop, and you need to have an action plan. You need to know and look for opportunities in your business where if you had an extra 20, 30, or even up to $100,000, what would you do with that money for growth? And then if you are ready to get a line of credit, go to www.integratedbusinessfinancing.com, fill out the short form, and we will work on getting you a line of credit in 24 to 48 hours. But have a plan. The biggest thing I can tell you is if you have a plan on how to use the money and how it's going to help impact your business and how it's going to help you grow, you're way ahead of your competition and you will always come out on top. So I integrate with your business, integrate for growth, integrate to scale, and I'll see you on the next one.